Artificial intelligence has been the dominant theme in the recent market rally, but with companies spending billions on new technology, we're also starting to get some questions about the sustainability of this rally. Joining us now to discuss is Jeff Evans from TD Asset Management. Jeff, great to have you back on the program.
Great to be here. Thanks for having me on.
I know that TD Asset Management is doing a lot of work on the economics around artificial intelligence. There's huge amounts of capital spending and how it's being funded and whether companies can actually make a return eventually from all this. Whole point of this big spend, right? You want to bring money in the door. What are your big takeaways?
Sure. Yeah, so we're always doing deep dives on individual companies that we own in our portfolios, really trying to understand each firm on its own and are they doing things that are logical. What we really wanted to do, and then we kind of had this exercise last week in one of our team offsites, we wanted to step back, look at the whole AI infrastructure in total, and just see if the whole group makes sense or if the numbers add up in total. A couple of interesting things. We started off with the CapEx numbers. So if you look at the hyperscalers, and that's where the bulk of the spend is on the chips, the data centers, the racking and cooling. Just under $400 billion of CapEx expected in 2025. That ramps up to $600 billion in 2027. And if we'd had this discussion 2 months ago, at the beginning of October, that was only $500 billion. So we've seen a $100 billion increase in that CapEx.
Into the mix. Yeah.
Into the mix. And then the scary thing is that's per year. So that's going to ramp up to about $600 billion, turns into $3 to $3.2 trillion of cumulative CapEx by 2030. So that's bigger than Canada. Canada's a $2.2 trillion economy, so we're talking significant spend from just 5 or 6 key companies here. First question that comes out of that is, how do you pay for that? $3 trillion is not a small sum of money, so where does it come from? The hyperscalers, fortunately, are very profitable companies today. They generate a lot of free cash flow. And if you add that up over the next 5 or 6 years, that's about $1 trillion that they can just recycle of their own capital back into the mix. It still leaves you $2 trillion to come up with. And what you're seeing, and I think Oracle is kind of setting the tone for this, is that it'll probably be funded largely with debt. So companies will go out and raise some debt and use that to spend money on chips. And of course, then the question is, do they have the capacity to do that? Good news is they have basically no debt today, so you could leverage up to, say, 2 times EBITDA. That's a perfectly normal number for a large cap US company. That gives you another $2 trillion of capacity if they do that. But then you get into an interesting dynamic of, can the debt markets even provide that? Historically, in a good year, the U.S. investment grade credit market only issues about 150 to 200 billion of net new debt. Hyperscalers need 400 billion a year, so you're still sitting on a $200 billion deficit. And if the hyperscalers take all of that 150 to 200 billion...
other companies need money.
Exactly. Yeah. They kind of starve everybody else of capital. So there's going to be a very interesting allocation decision here of how much of this actually goes to the hyperscalers, how much goes elsewhere. What it could do is it could push interest rates and credit spreads up just to kind of net this all out. So that's an interesting piece of this. The banks will provide some financing, but the other area where you really need investors to come in is through private credit. That's where the big pools of money are. That's where you're probably going to see the bulk of this. We do think that the money is there, but you're seeing an interesting bumpy ride this year with elevated defaults in private credit. So there's some questions about whether or not they're going to be willing to lend as aggressively perhaps as they have in the past. Lots more concern on underwriting or focus on that today. So we think this is doable. The 3.2 is probably achievable. You do need a lot of things to go right, though, and there are going to be some interesting decisions along the way on allocating capital back and forth. So the funding side we think is good. Then the other big question, of course, is can you earn a return on this? We went through an exercise where it was sort of an unfortunate exercise, but we went through all the white-collar jobs that AI could potentially replace. That's somewhere between a $7 to $10 trillion wage pool globally. If you assume about a 10% share that AI captures by 2030, that's $700 billion of revenue. Obviously, they have expenses to run their businesses, so you're probably looking at $300 billion of profit on $3 trillion of capex. That's a 10% return. So we came out of this pretty comfortable that you could earn a return. But the other interesting question is 10% good enough? The hyperscalers make a lot of money. They're 20 to 30% return on equity businesses. 10% may not be enough to keep investors happy in that. So our key takeaway here is there's probably some more work for investors to do on the financing side to really make sure that this gets financed. And then it looks like we can earn a return on this over time. It's still too early to know exactly what that's going to be. And there is a risk that this could be a little bit weaker than what investors have come to be accustomed for in the tech stocks.
I understand as you're doing this research, you actually said if we're going to research AI, why don't we use AI to do some of this and identify some major themes? Semis, grid infrastructure, and software, I think, is what it came up with.
Exactly. So the big challenge is there's AI, but then the reality is there's lots of little themes that are going on, lots of rotations under the surface. The chip companies, the hyperscalers, the software, the grid, all of these different pieces. And so we used AI to help us classify all these companies. We said just put them into different buckets. You can only be in one bucket at a time. And then what we did is we said, is there momentum? Is there thematic rotation or momentum across these different themes? And what we found was that at about a 9 to 12 month horizon, if one of these themes get going, if the market gets behind it, it tends to stick around for up to about a year. So that was interesting to see. And then what's also been interesting is how that's ebbed and flowed over the course of the year. If you go back to January, it was all about the chip companies, NVIDIA's and Broadcom. We've seen that roll off a little bit. They're still very strong overall, but not in our top 5 theme buckets now. What has been a little bit more persistent is the power side. It's actually getting the power to these data centers, the transformers, the power lines, the natural gas generators and turbines. All of that has been fairly persistent and stayed within the top end of the bucket. And then what we're seeing now more recently is it's the software companies, it's the end use cases that the market is starting to focus on. So a bit of a migration away from the chips, more to the end use cases is what we've seen evolve over the course of the year.
At any point when you're asking AI about AI, was it critical of itself?
It was an interesting process. We did lots of iteration, and there's a view that you can type this in, get an answer back in 20 minutes. I think we spent about 5 days in total working with AI to actually come up with this project. So it was not as straightforward as one might initially think, but it led to some pretty interesting results.
A lot of fears about bubble. Obviously, the bubble chatter seems to pop up all through the year, right? And then people start saying, is this 1999 all over again with the internet boom and bust? Well, I mean, the internet's still here. So you look at valuations, you look at earnings growth, and we hear about the bubble chatter. Does it all make sense, or?
So part of that was this exercise of, is this actually going to make sense in the long run on the AI? And again, we're comfortable you can earn a return. That was very different in 2000. There's lots of fiber optic cable that got put in the ground that is only now earning a return a couple decades later. So we're more optimistic that these companies can earn a return faster on that. But if you look at the broader equity market, the S&P is not trading at 40 times earnings the way it was in the dot-com bubble, but it is at 22. That is the highest outside of the bubble it's ever traded at. Earnings growth expectations are about 15% per year for the next 2 years. That's 3 times higher than average. So these are some pretty lofty earnings growth expectations. As long as we get that, the multiples are fine. The bigger question is, are we going to see that? What we have seen most recently is companies are meeting and exceeding those estimates. In the third quarter, companies blew through estimates and raised guidance pretty much across the board. So the short-term data looks optimistic. I think what investors need to focus on in 2026 is if companies are showing any signs of not being able to meet these very elevated expectations, that's where it becomes concerning. But then you look at all the other macro. We're getting interest rate cuts. We're getting the OBBA stimulus kicking in next year. If it's going to happen, it's probably more of a back half thing, but certainly something for investors to keep a focus on. Are companies meeting very, very elevated earnings growth expectations?